Hi, I'm Steve Hobbs. I'm a managing director with Portivity and lead the firm's public company transformation solution. I'm joined by Frank Hatheway, who is the chief economist at NASDAQ OMX. Frank, with all of the recent activity in strong IPO markets, there's a lot of questions out there as to how long is this window going to stay open? What are the factors that could cause it to close or stay open for a long period of time? Can you share with us at least 2 or 3 things that people might look for that would be an indicator of what the future holds?
Sure, happy to, Steve. One of the strongest drivers of the market so far, the IPO market, has been the overall performance of the stock market and stock market indices. So clearly we're all looking at that when we think about where we might be able to take our company public. One of the things that people are less apt to be aware of is that investors have appetites for risk that get affected by what's happening in the political realm and the broader economic realm. So if you start seeing disturbances to the economy originating in Washington or disturbances in the economy originating in the Eurozone, that's going to have an effect on your ability to do an IPO. It might not be something you really think of, and why should something happening in the Italian government have an impact on my ability to take my company public? It does, because it affects investors' appetites for risk. As we look ahead, all right, things in Washington aren't as smooth as they could be, but the disruption this past month wasn't that bad. Hopefully they've learned from that, and what we go through in the first quarter of 2014 will be smoother. The Eurozone seems to be stable, so if we can keep these things moving forward in the political process, not really disrupting the economy too badly, the strong stock market should continue to fuel good demand from investors for shares of IPOs and new types of companies and technologies, and ought to be good for companies that seek to raise money in the public capital markets.
So for companies that are thinking about going out in 2014 or 2015, looking after the fact, what would be advice you would give to CEOs or CFOs from your perspective and your years of experience?
I think one of the things that companies don't necessarily all adequately prepare for is a need for a strong public-facing IR program. Going through the IPO process, people do a good job on talking to the key investors that will be buying shares on the IPO. Not everyone is quite as ready to be a public company from an IR perspective as they ought to be.
From your perspective, what impact has the Jobs Act had on IPOs, and have we seen the impact of that, or is that yet to be seen?
Well, the most immediate impact was the use of the confidential filing process, and that's been extremely popular. It actually hinders the transition to being a public company a little bit in one narrow way. People get used to talking to investors in a confidential setting. Now, once they're public, you can't do that anymore. So a company, once it's gone public, has to make that transition. But that's just been a short-term reaction to the Jobs Act, the use of the confidential filing capabilities. Longer run, when more of the regulations are in place, and there's still a number to be put in place, a crowdfunding proposal just came out a week ago, we're going to see, I think, another niche develop that's neither purely public nor purely private, but as sort of a growth of this middle area that might be ideal for smaller companies looking to raise capital, perhaps from institutional investors or from individuals, in a way that's a little easier to be done than was the case prior to the Jobs Act. So the Jobs Act, we had a short-term reaction that has been positive and I think consistent with what the Congress intended, and we're going to see longer-term reactions that should ease the ability of companies of all sizes to raise capital once the regulations get in place and the industry adapts to what these regulations mean for them.
What do investors learn from the pricing process that occurs during an IPO?
There's 2 parts of the pricing process investors learn from. The first is the IPO price itself, which is set in the pricing meeting before an IPO opens. And the second is from the opening price of the IPO when trading begins in the stock exchange. And those 2 signals taken together are affirmations for the company about how the market is evaluating their efforts they've taken in bringing the company public. So a strong pricing meeting, pricing on the higher end of the range, good signal to the market, and then a strong opening in the stock the next day reinforces that signal to the market. So essentially you want a series of 2 steps, both of which say the same thing, that the market is valuing this company well, and it has prospects, it has ideas, it has products that you as an investor who maybe didn't get in part of the IPO allocation or maybe didn't get in sort of on the first trade of the day ought to consider as part of your portfolio.